and welcome to the Canaccord Coffee Break podcast. I'm Jane Parry, the Chief Marketing Officer here at Canaccord Wealth, and I'm delighted to be joined today by Tom Hibbert from our Chief Investment Office.
Hello, Jane.
Morning,
Hi, everyone.
Morning. So for our regular listeners, you will know this is a bite-sized market insight in just under 10 minutes, hopefully, if we keep to time. And if you like what you're hearing, please don't forget to hit follow on Spotify or Apple, and you will never miss an episode. So welcome to this week's Canaccord Coffee Break. Grab your coffee. And after all the commentary in the last couple of weeks about the UK budget, we are going to go back to what's happening in the markets and shift our focus towards the central banks in particular. This week, Tom, we are going to jump into our Santa sleigh and quickly travel around the world, visiting the US, the UK and Japan.
Let's do it.
Let's do it. Ho, ho, ho. And we're going to ask the question, are the markets set up for a Santa rally? So first off, could you just briefly summarise where the markets are at the moment? It feels like quite quiet to me.
Yeah, I mean, so it has been quiet. We saw a little bit of weakness in the first half of November, followed by quite a strong recovery into December. So a bit of a sort of Santa rally at the end of November, if you like. Last week, equity markets were more sort of range-bound. There was
range-bound?
No clear trend, effectively.
Okay. So not meaningfully up or down?
Exactly.
Okay.
But still, positive sentiment that has driven markets since April, still very much there. So that hasn't faded. I think there was just a bit of lack of trend before these major central bank meetings. Starting this week with the Fed, and then next week we've got the Bank of England and the Bank of Japan. I expect positive outcomes from those meetings, particularly from the Fed and the Bank of England, so we can jump into that. But that should set the scene, along with all of the other positive things that people are talking about, for a bit of a Santa rally in December. So hopefully we'll see. So
let's jump in our sleigh then and go off to the US.
Yep.
So the US Federal Reserve, the Fed, is due to meet this week.
That's right,
What are you expecting to hear from the Fed?
So we expect them to cut interest rates this week.
Okay.
And that, there was some uncertainty about that previously, but that looks more and more likely as time has passed. So really do expect an interest rate cut. The interesting thing for the Fed at the moment is that they're cutting interest rates into a very strong economic situation. The US economy has been really very, very strong. It's growing at sort of roughly 7% nominal growth rate.
Gosh, we'd love that here, wouldn't we?
We really would. And you look at the different factors of what's driving that.
Yeah.
There's a very positive fiscal backdrop, deregulation, governments are spending a lot of money. You've got a positive monetary policy backdrop as well, with interest rate cuts coming, and the Fed sort of looking at injecting a bit more liquidity as well into the market through what they call balance sheet maintenance, which is getting a bit technical, but that should provide some liquidity in December and early next year as well, which should be another positive tailwind. And then you have things like just surging AI-related capex,
which we've talked about
as well,
and
a very strong corporate landscape. So while that sort of backdrop reinforces the sort of US-led market strength that we've seen, the Fed is cutting interest rates really because of what people describe as a K-shaped economy.
A K-shaped economy.
So in aggregate, the economy's been very strong, but it's also quite narrow. I mean, all of those positive things are quite narrow. The stock market's been very strong, but again, that's quite narrow. Some areas are struggling. So,
like what sort of things? So
lower income consumers are struggling.
Yeah.
Debt costs are high, interest rates are high. There's been a lot of inflation. We've just come off the back of a period of high inflation, which has eroded some of their purchasing power. You see weakness in some of the more cyclical and interest rate sensitive parts of the economy, so smaller companies which tend to pay more floating rate debt. The housing market is a bit stale. There's not, people aren't wanting to move houses. Mortgage rates are still quite high. And then you've got manufacturing. Manufacturing output and activity has been quite slow as well on the back of this sort of high interest rate environment. So yes, I expect the Fed to cut rates to ease the pressure off those areas.
Yeah.
But they're easing into a place of quite aggregate strength, quite a hot economy, which I think does raise a few questions about the longer-term policy outlook and the market expectations for more interest rate cuts in 2026 and what that means, I think, for inflation looking further out.
And I heard there was speculation of a new Fed chair, Kevin Hassett.
Yes, so good question. It's worth pointing that out because you look at the market odds and Kevin Hassett, he's emerged as the clear favourite to replace Jerome Powell. And that has, had some market impact as well. And it's just an interesting discussion. So people are sort of focused on his reputation as a dove.
A dove. Okay. Tell me what a dove is.
A dove is someone who's a proponent of lowering interest rates or lower interest rates.
Yep.
More stimulative monetary policy.
So supporting what you've just been talking about and what we expect the Fed to do in the next week or so.
And he's aligned with MAGA as well.
Okay.
He's more of a MAGA guy. So there's this alignment with the US administration, which has also raised a few concerns about whether his appointment would erode some of the Fed's independence.
Yeah.
I think actually, although there is obviously this blurring of the lines between the Fed and the US administration, there's also that line has blurred quite a long time ago.
Yeah.
And what we're seeing now, the US administration is quite keen for just more normal policy tools. So it could, as well as being, the questions around dependence or the independence of the Fed, I think actually we could just be seeing a reversion back to more normal monetary policy, back to normality. I think that's almost underappreciated by the market at the moment.
Okay. It would be interesting to see how that plays out then over the next few months, I guess.
Absolutely.
So can we jump back in our sleigh and come back to the UK? The Bank of England is also due to meet in the next week. What are you expecting to see there?
So again, expect the Bank of England to cut rates as well, which should be supportive of markets in the UK, should be supportive of the economy. The other thing that we're seeing in the UK that I think supports the Bank of England in their pursuit of lowering interest rates is we have started to see a little bit of more disinflation in the UK, evidence of slowing inflation in the UK, which supports the case for interest rate cuts. At the same time as growth is pretty slow, the Bank of England does have more room to cut interest rates, and it's helped by this disinflationary environment. So the view is now, if you look at different measures of inflation is coming down.
Yeah.
I think the Bank of England are on this pursuit of gradually lowering interest rates. They could do it even more quickly. And at the moment, you've got UK government bond yields that are higher than US government bond yields. We could see UK bond yields, develop more positive momentum into the year end and early next year.
Great, thank you. And finally, Japan. Hang on, we've got to get in our sleigh first. Off we go. Ho, ho, ho. Right, let's land in the Bank of Japan.
Yes.
This is an entirely different situation, isn't it, compared to the US and the UK? Just tell me a little bit about what's going on there.
Yeah, so Japan have had over a decade of very loose monetary policy, negative interest rates. They've had negative interest rate policy.
Yep.
They've had yield curve control, where the Bank of Japan has been hoovering up all of the government debt. Japan makes up a huge portion of the global bond market. It's a very big bond market.
Gosh, I didn't know that.
Yeah, Japan's debt to GDP is 230%. So it's an indebted nation.
Yep.
And they've really struggled to have any inflation, which is why they've had
for years and years.
For years. Finally, they have some inflation.
Okay.
So the Bank of Japan have been able to slowly start to cautiously abandon negative interest rate policy and yield curve control and things like that. And it now looks like the Bank of Japan might hike rates in their meeting on the 19th of December. So, the Governor Ueda has come out and said that he's likely to hike rates. And the government, which usually puts some pressure on the Bank of Japan, has said that they're not going to fight that decision. So the odds of an interest rate hike from Japan this month has increased very sharply in the last week. And we've seen a strong rise in Japanese government bond yields as well. So the 10-year Japanese government bond yield is heading towards sort of the 2% level, which is the highest in almost 20 years, since 2007.
Wow, okay.
So that has some implications for other bond markets as well, because it makes up such a big portion of the global bond market. It's not as big as the US market, but...
So how does that work then? How does that impact other bond markets?
I suppose there will be more buyers of Japanese government bonds
because the yields
are higher.
Yeah, okay.
Yeah.
So just very briefly then, do we think a Santa rally is likely?
Yeah, all of the things that I mentioned with interest rate cuts incoming, as well as some of the other tailwinds, I wouldn't be surprised if we do get a bit of a Santa rally. December tends to be a strong month. Consumers are spending a lot of money. So there are those existing tailwinds. The one thing that makes me cautious is that it seems to be everyone's base case. Everybody expects a Santa rally. And sometimes, it's that can be a risk.
Sometimes you don't get
itself,
everything you want on your Christmas wish list.
That's exactly right.
Brilliant. Thank you very much indeed for your time. So let me quickly sum up what's in my Canaccord coffee cup to take away today. We have focused on central banks this week and asked if cutting interest rates might lead to a Santa rally, as rate cuts often support the equity markets.
Yeah.
We talked about doves. We didn't talk about hawks, but the way I can remember the difference between doves and hawks is doves fly low because they like low interest rates. Hawks fly high because they like higher interest rates.
I suppose the Bank of England and the Fed are more dovish because they're lowering interest rates. The Bank of Japan has become more hawkish this week.
Yes. And we talked about Japan, and I did not know it was one of the world's largest bond markets, but I do now. And we talked about the US having a K economy. That's quite narrow, but some people at the bottom of the K.
Narrow but very strong.
Yeah.
But there are people who are struggling.
Yeah. So on that note, wishing everybody a very happy Christmas, and we'll talk again in the new year.
Thank you, everyone. Thank you for listening.
Investment involves risk. The value of investments and the income from them can go down as well as up, and you may not get back the original amount invested. Past performance is not a reliable indicator of future performance. The information provided is not to be treated as specific advice. It has no regard for the specific investment objectives, financial situation, or needs of any specific person or entity. It is accurate at the time of recording and is subject to change.